101.9 megahertz of life.
Good evening. It's that time of the week again. It's Thursday. It is just gone. It's about 9 minutes past 8. 8? Did I say 8? I meant 6. It's 9 minutes past 6. It's the ORT Business Show. I'm David Zeidel, and tonight we've got Clive Butkow with us. Good evening, Clive.
Hi, good evening, Dave, and to all the listeners.
Thank you. And I'm going to introduce Clive in a minute, but as you know, we start off with just a little bit of a business story. And the story you might have heard, and if you're old enough, you might know what a VHS and a Betamax video machine is. There were two companies competing with each other with different business models. It is known that the Betamax was a much better machine. It's more quality, but VHS beat it in the market. And the reason for that is that VHS basically gave away the machines at cost. So that when you wanted to buy a video machine, you had a high-priced Betamax or low-priced, almost felt like it was being given away, VHS. And they won the war. And how did VHS make money if they gave it away at cost? Is that they created the opportunity to sell the tapes. They made the money off the tapes. So they gave you the device that would use their tapes rather than the Betamax tapes. And that's just a different model, and it's about businesses around getting your customers to use your product, and they're different pricing things. And it relates to what I'd call the Kodak moment. We all know that Kodak used to be the best film company in the world, selling cameras and films. And then the digital age came about. In fact, Kodak was around since 1888. And they were the best. And in the 1970s and 80s, digital cameras came around. And you know who invented the digital camera? It was Kodak themselves. An engineer at Kodak invented the digital camera, explained that this was going to be the future, and the leaders of Kodak at the time said it's just a fad and didn't believe this. And what happened was the rest of the world overtook them, and in 2012, Kodak then went into bankruptcy. They thought that digital photography would never ever catch on, and it did. And the lesson behind that is you might be the leader, but the world is changing, and you need to change with the world. And hopefully Clive is going to explain to us how you would do that as a company. Just a little bit of an introduction to Clive. He's the CEO of Conducive Capital. It's a disruptive digital technology venture capital fund. He was also the founder and the CEO of Kalon Venture Partners. And he's also the former COO of Accenture South Africa. He's got over 28 years of management consulting experience. And during the time that he was with Accenture, he attended various sales training courses across the world. And he used all those lessons to train thousands of people in Accenture in what was called high-performance selling. And the basis of every company is being able to sell its product. And Clive, I don't know if you remember, but many years ago, Clive gave a talk to one of my classes. I was lecturing at one of the business schools, and he came in and gave a talk. And he said, you should always follow the ABC method. And when we asked him, what's the ABC method? It was always be closing. Whenever you're in business, you always need to be closing. You need to be making those sales. And he currently runs sales training for numerous organizations, including, in fact, ORT, EO, and YPO, and many others. He's going to share those lessons, the lessons of selling. He's going to share the lessons of understanding as an investor, what is investable in different companies? Why would he invest in one company and not in another? And he's going to categorize it for us in 3 different levels. One is smaller companies, if your turnover is less than $1 million, if it's between $1 million and 10 million, and then the bigger companies greater than 100 million. So Clive, welcome. And I, for one, are very keen to understand and to listen to what you can share around that. And where would you like to start? Do you want to start with the venture capital information, or do you want to start about and talking about high performance selling?
Yeah, I'm okay either way, Dave. I mean, we can talk about venture capital. It's definitely on everyone's mind at the moment. Is how there's so many companies out there trying to raise capital, and we all know the statistics say that 1 in 100 will. So it's great that you're optimistic. Go, you do your best, put your best foot forward, but don't be disappointed if you don't raise, because it's a very low probability that companies raise. And just to give you the stats, I mean, basically, when I ran Kano Venture Partners, we made 11 investments, and we probably saw over 1,100 companies. So we basically invest in 1 in 100. And I want to just qualify that. People would say to me, well, what was wrong with the other 99? And often I say nothing. They just weren't venture capital investable business. A good business does not equal a venture capital investable business. And why do I say that? Is because a venture capital investable business is one we look for a 10 to 100 times return on our capital. So if we put in $1 million in 7 to 10 years, we want to get $10 to $100 million back, preferably $100 million back. But there are many, many good businesses out there with good founders. Maybe they're not entrepreneurs, they're good founders, but they have good businesses, but they'll make 1, 2, 3 times return on capital. And that's not the type of businesses we look for, or not just we look for. Any true venture capital company around the globe, they look for the 100 baggers, as they call them. What we look for in a fund, if we make 11 investments and 10 of them go bust and one of them does 100x return on capital, we will more than make the returns, the 30% IRR returns that we're looking for to our investors. So all you need is one home run. When I worked in Silicon Valley many years ago, they, being big baseball fans, they talk about 262. And if you know baseball, they talk about 2 home runs, which is your 1,000 baggers. Then they talk about 6, you'll get to first base, second base, or third base. You're either going to get a 1 times return on capital, 2 times return on capital, 3 times return on capital, and 2 strikeouts where you're gonna lose your money. Now, if you're doing 262, you're actually not doing badly. If you only have 2 strikeouts out of 10, you're actually in pretty good territory. So that's the sort of analogy and metaphor I've always used in my investments. We don't invest to lose money on 8 of them or lose money on 2 of them. We invest to make 100 times on every single one. But we unfortunately we can't look in that in that golden ball and say that's going to be the winner or not. There's just sometimes stuff happens, and as great as it was at some point, something goes wrong, and then it's just the momentum starts building, and things just go wrong with the company, and they can go insolvent. So
if I hear you correctly, first of all, the message is, if you go to a venture capitalist and you're looking for some funding and they say no, it doesn't mean that you're a bad company. It just means that it's not good for this particular venture capital fund, and they're looking for massive growth, not just ordinary growth. And then the second thing is, what is the specifics that you look at? So you're looking for a company to grow 10 times, 100 times. What are the things that will make it investable for you?
So in Kalon and in Conducive Capital, when we do raise capital, we're looking at more growth capital than early stage capital. So we're looking at where business is doing, 100,000 Rand a month to $1 million, 2 million Rand a month. That's the sort of stage we're looking at. So it's more putting the foot on the gas and speeding up the car. So we would like to say that it's got a repeatable and scalable and profitable sales model. So if you put in $1 million, you're going to get 2, 3, 4, 5, 10 out, coming out the other side. It's not you're going to put $1 million in and you're going to get $50,000 out. That's not a good business model. That's not the sort of economics we look for when we make that investment. It can happen. It can happen to anyone, but that's not what we plan on. But if you look at, I'm always use my little 5 T's. So I would always use the 5 T's of an investment. Number one is the team. I could say all five of the team, and team. When you buy a house, you look at location. When we make an investment, it's team. And I'll go into some of the criteria we look for in the team, but you have to have a world-class team. So at a minimum, I back technology companies, so software technology companies. So at a minimum, I want to see someone that can build the stuff, the engineer, and someone that can sell the stuff. Now, very infrequently, you might find one person that can actually do both. It's very infrequent. It's not impossible. It has happened. We have made investments into solo founders, but it's very, very rare we make investments into solo founders. So we love to see the great engineer. They really understand how to build a product. They're outstanding in their engineering ability. They can orchestrate the right solution. They understand the architecture. And then you need the great commercial person, the person that can sell, the person that can, always be closing with employees, always be closing with investors, always be closing with customers, etc. So number one is the team. We absolutely have to have an outstanding team.
Great. So if you're wondering who am I talking to, I'm talking to Clive Butkow. It's David Zeidel. This is the ORT Business Show. And Clive's talking about the 5 T's. And the first T is team. And we normally go for a coffee break now, but maybe because it's the 5 T's, we should go for a tea break. And we'll pick it up after the tea break.
High FM, your station of choice since 2008.
Welcome back. This is the ORT Business Show. I'm David Zeidel, and I'm speaking to Clive Butkow. And he's busy talking about companies that are investable and what's the important stuff, what's the secret sauce. And he says, well, the secret sauce is made up of 5 T's. And he mentioned the first T, which is the team. What are the T's, Clive?
So the second T is the technology. So we want something that is very innovative. So let's say it's in the payment space, it's competing with all the payments companies, credit card, debit card, electronic funds transfer. We want to make sure it's 10 times better than any other product in the marketplace. So that's a very important one for us. Obviously, we're an innovative software technology venture capital company. So you have to have an innovative technology. We don't want to invest in a Me Too company. That is, if I look at the company and there's 50 competitors in Johannesburg and they're all, they basically all they compete on is price because they're just a commodity. We're not investing in commodities. We want to invest in something that's extremely disruptive. It's disrupting an industry. We've got one of the investments is in the auto industry, and it's fundamentally disrupted the whole automotive industry. You can get an insurance quote by just taking a picture of the car, and then it sends that to the insurance company, and in a couple of seconds, you've got a quote. Now, if you have an accident in your car, you would know that's weeks or months to actually get that quote. So we can do this in seconds. That is very disruptive. Very few companies around the world actually do that. So that's the type of technology we look for. I mean, if you talk technology today, there's 2 types of the majority of what I do in my own personal angel investment capacity or in the venture capital capacity is artificial intelligence. And that is really disrupting. It is so fundamentally transformative what's happening in the artificial intelligence world that I'm always looking and constantly looking for not only artificial intelligence, I want artificial intelligence-led companies. So they lead by disruption and artificial intelligence. They're not just a little soft wrapper of another company. So everyone says they're using artificial intelligence because they're using ChatGPT. That doesn't mean you're using artificial intelligence. That's just a soft, light wrapper. I'm not interested in those companies. I want artificial intelligence first. So that's the type of technology we look for. That's very disruptive. That's not easy to copy, etc. So that's the second T. The third T is a target addressable market. We want to really get 100 times return on capital, we have to have a large target addressable market. So it's got to be something that is not, it's got to be not 10 customers or 100 customers. It's got to be millions of customers around the globe, in South Africa, Africa, and around the globe. Makes it a very big, large target addressable market. So if it's not, it could be a fantastic product, but there's only 100 customers in the world. It's not going to get us the 100 times return on our capital because you can sell it to 100% of the market and you might be a 5 million rand company. And that's not, that's not going to get us anywhere. So it's got to start small. We like niche to start small. Start in a little pond that's maybe only got 100 customers and you get 10 out of the 100. And then you go to a lake and then you go to a sea where you can get thousands or millions of types of customers. So we don't mind it starting small. We're very happy with niche. Niche rhymes with rich, and I like niche, but it can't be niche forever. It's got to be a big market. So if you're going to the Indian market or the African market, where there's 1.4 billion people, India 1.4 billion or whatever that number is, China 1.5 billion, America 400 million. These are big markets. So these are the type of markets we look for. That's at 30, which is the target addressable market. The fourth one is traction. So we want to see, we're not, as an investor, not in my own personal capacity, but in our venture capital capacity, we're not early stage investors. We don't invest when you just got a product, or you pre-product, or you seed, or you pre-seed. We invest when you've got a product, you've got some traction, you've got, let's just say it's a software as a service, or it's an AR type company which has got high usage, where you're doing $500,000 a month. I like that number of $500,000 a month. It can be lower, it could be higher, but that's a rough estimate of the traction that we look for. So just to
interrupt you, just before you give us the last T, when you say traction, you're talking about sales, you're making sales.
So revenue. So it's revenue, when we talk, it's actually revenue, because sales, it could be a sale that could last, be something that only kicks off in 12 months' time. That's not really, I'm being a bit technical now between sales and revenue. But what we look for is revenue. We like software as a services businesses, which are subscription-based revenue. So from that client, I get 100,000 Rand a month every single month for the next 10 years. That's a really nice business model to make it happen. And then, so that's the traction that we're talking about. It's revenue traction that we know. We don't invest in if you've got eyeballs or clicks or just users that aren't paying. That's not a sustainable business model. Just having a user on your platform, that doesn't mean they're going to ever turn into a paying client. So a lot of companies come to me and say, I've got 100,000 users. And I'll say, well, how many of them are paying? Oh, 7. You can take it to someone else, but I'm not interested in 7 paying clients. So either you have to convert that 100,000 to paying clients, and then I get interested, because if you're converting 50,000 and you're making R1 million a month, that is really interesting to me. But number of users, often I see click-through rate. They go onto the website and they click on the rates. I say, well, what's your business model? How do you make money? No, we don't make money from click-through rate, or they try and make money from advertising revenue. Now, I don't see that as being a sustainable business model. If you're Facebook, or you're an X, or you're an Instagram or TikTok, yes, they've got hundreds of millions of users. They can make money off advertising revenue. But there's very, very few companies around the globe that have actually ever made a sustainable business model off advertising revenue. So I'm not one who invests, unless I get a chance at Facebook. I'm not going to invest in a company that's doing advertising revenue, because particularly in South Africa, there's just no money in that business model to actually make it that way. So that's the traction that I'm referring to. And it's a very good question you asked today, because a lot of people say traction is how many people get to my website every day, or how many users I've got, or how many employees I've got, or how much money I've raised, or how much, all the other things that are actually just vanity metrics. They're not realistic metrics. I want to know how much revenue you're generating, how much have you sold, how much you're going to be generating next month, what's your growth month on month. I want to make sure when I talk traction that I look at the unit economics of the company, so the financials of the company, that they actually make sense. I can sell you a rand for 75 cents, and that's fantastic for you. I'll never stop getting clients, but the problem is every rand I'm spending, I'm only getting 75 cents back. So I've got product market fit. I've got a great business. I can tell you I've got a great business, but I actually don't, because I'm never going to actually make any money. We're in business to make a profit. We're in business to make money, a gross profit, a net profit, operating margin, free cash flow. That's what we're in business for. So that unit economics, Warren Buffett said accounting is the language of business. And one of the things, if I gave any advice and tip to any entrepreneur listening here tonight, or any founder, know your numbers. Know what your numbers mean. Know what it costs you to make something. Know what gross profit means. Know how much you're selling it for. Know what your operating margin is. That's after all your R&D, research and development, your sales and marketing, your SG&A costs. Know what that operating margin is. You might be making a loss today. I don't mind that. But I want to see a path to profitability. I want to know in 2, 1, 6 months, 8 months, 9 months, 12 months, that you're actually going to actually make a profit in your business. Or I'm happy maybe just to keep on just investing in you just for top line growth. But I know over time you will get to the bottom line growth and you will get to profitability. I'm okay with that, but I want to see that path to profitability. And I don't see that in many entrepreneurs. I see it as a major, major weakness. When I ask them, tell me about your numbers, how many months left of runway have you got? What's your burn rate per month? So how much cash is actually going out the business every month? They say, well, I don't really know. I'll speak to my accountant. I'm out. Immediately I hear that, I've just lost the interest. I'm out, because you as an entrepreneur have to know those numbers. Yes, your accountant might be providing you those numbers, but you've got to understand them. You have to understand them as well as anyone else can understand them. I'm a venture capitalist. I've got a computer science degree. I'm not an accountant, but I can tell you every single line item on an income statement, every single line item on a balance sheet, every single line item on a cash flow statement. Those three documents, you have to get to know. So that's the traction in unit economics.
Fantastic. So really, if somebody's asking who we're talking, if you've just tuned in, I'm talking to Clive Butkow, and he's in a sense a dragon's den or a shark tank in real life of investing in companies, and he's sharing the 5 T's with us, and he's gone through 4 of them. It's the team, technology, a targeted addressable market, and traction. And he was just talking about the traction. That traction actually means money that's coming in, actual sales. And Clive, what's the 5th T?
So the 5th T I call the trenches, which is a moat. So what I need is, I'd like to see every company that I build in that has an 18-month moat around the castle. And I'm using that metaphor around the old days of having a castle and the fighting and the wars. But what I mean there is, if you've got a technology that you're 18 months ahead of the competition. So as they start catching up, we keep on innovating and we stay 18 months ahead. So those trenches have got to be, I don't want a company I'm investing in that someone else can put R1 million in, and in 4 weeks I've got exactly what I've got, what I'm investing in. Then there's no moat around this castle. They don't have that trench. So I want to see they've got defensibility. And defensibility could be they've landed their top 20 of the 100 JSC clients. That's defensibility, because there's a big switching cost. Once you go with some technology sometime, you can't just switch it out and go with another one. Well, you can, but it's very expensive. You have to retrain your organization. It's a very expensive exercise to go through. So that defensibility could be the technology is 18 months ahead. The customers are 18 months ahead. The business model is 18 months ahead. It could be a lot of things that could actually create that defensibility, which we would look at. It's not just technology defensibility. That is a big one, but there's other forms of defensibility as well. So that ultimately is the 5 T's that I look for not in the entrepreneur, because I've got a number of things I look for in the entrepreneur to make the investment, or the team, but that's the 5 things I look for as a company, as a business, as something I'm going to make a good return for my investors. I'm a venture capitalist. I invest other people's money. I have to make sure I give them and our target is a 30% internal rate of return. So that's a compounded annual growth rate of 30%. So if I'm successful, I get a 30% return on my capital to my investors when we sell the company and they exit the fund.
Wow, that's fantastic. And you still see opportunities like this in South Africa presenting? I know you say you only invest in 1 in 100, but are there still so many companies out there that you can choose just the 1 in 100?
No, Dave, there's no shortage of companies. There's say in my own personal capacity, I've made a number of angel investments. They're early stage, but these businesses are already taking off. They're just getting unbelievable traction and all the things that I spoke about. But I see and I hear about and I read about there are so many brilliant minds in this country. Brilliant minds, brilliant opportunities. And Africa, if you think about Africa, it's got so many problems. But a problem in the entrepreneurial world means opportunity. And we've got these creative, innovative entrepreneurs that are solving these big problems. That's what businesses do. They solve problems. They must be a painkiller, an aspirin that solves a problem, not a vitamin that's a nice to have, but a painkiller that's a need to have. And there are just hundreds of them out there. There really are. I was at a conference yesterday where there was 20 businesses from Africa. They weren't from South Africa, but from Africa. And the innovation that these guys are coming up with and the problems that they're solving on our continent are mind-blowing. And I keep on thinking, at what stage will they run out? But with technology moving at the pace it's moving, what we see now is AR business after AR business solving another problem and solving another problem, whether it's more revenue, whether it's a decreased time, whether it's decreased costs, whether it's coding. You look at AR today, 85% of code can be written by an AR type of. So it's not that you're replacing people necessarily. You're getting much more productivity from that artificial intelligence, like Anthropic, that's got something called Claude 3.7. They can write code better than probably most other AR companies in the world. And they just enable coders and engineers to be far more productive. And they are, because they don't have to write the 100% of code anymore. They can write 20% of the code which I don't think will be happened by a robot in the foreseeable future, but you're still going to need human beings to do that. So there is just no shortage of great entrepreneurs, great ideas, great innovation.
Fantastic. And if I take you back to your first T, which is team, and you said the team is about building it and then selling it. So let's move on to the high performance selling. You've been on a lot of courses. You actually now use a lot of that information to train. What is high performance selling? And if I've got a product and I want to sell this product, what are the key things I should be focusing on? What are the key things in selling?
Well, there's lots of them. So I put it I won't go through the 10, but I put it the 10 lessons to high performance selling. But what's high performance selling is, it is so competitive out there. You know, when I started at Accenture all those years ago and I was selling, the customer was very naive. They were very ignorant. They didn't have access to know who the competitors were. There was no such thing called the internet. There was no way of actually finding and comparing different products and knowing what's happening globally and what's happening around the world, et cetera, et cetera. So it was very much a transactional type of sale. You had a good brand, we had an Accenture brand, we might have had a reasonably good product or an okay-ish product, not even a great product, and we could sell it based on a good relationship, but nothing more than just a good relationship. If you look at today, the buyers are very well armed with what's happening out in the marketplace. They know there's 10 competitors. They know the different points from the competitors. They can go to AI and say, why is A better than B? They've got the Gartner report. They are so much more trained up and intelligent than they ever were before. So they can make very, very well-informed decisions. So that's why I call it high-performance selling. If you want to beat the competition and you want to beat them based on all the things that you need to look out for, you need to be a high-performance salesperson. You need to understand a lot of things, like I'll start number one, which is the ideal customer profile. You know, you can't sell if someone's hair's not on fire or they don't have hair, you're not going to sell them shampoo. You know, it doesn't help me going out to the internet and say, give me 100,000 bald people because I've got a great shampoo I want to sell. You've got the wrong RCP, the ideal customer profile. What you want is people that got lots of hair or they want to grow their hair back or something like that. So you need number one. Number one is to find the ideal customer profile. So if we're selling to, let's go back to that example I used. Let me give you an example of a company that I've invested in recently. It's a company called Hire Sales. And what this company does, it's got hundreds and hundreds of salespeople on their books. It's a platform. It's like Uber. It's got supply and it's got demand. The demand comes from the entrepreneurial companies, the corporates that need to hire world-class salespeople. And this business, Hire Sales, provides those world-class salespeople. So the platform, you get the demand and then they provide the supply and they charge whatever they charge for every single person that they staff up. So this is solving a significant problem. And the problem is that people don't know how to hire salespeople. They don't know how to hire them. They don't know what, do they need previous domain expertise? Do they need previous technological expertise? What sort of expertise have they sold at the price point that the new company is selling at? So there's so much stuff that they need to understand. And what they can do now, instead of seeing hundreds and hundreds of CVs themselves, they rather just go to Hire Sales, who's actually done the filtration already. They've done the sieving out of those CVs, and they've had thousands of people, and they've got it down to a couple of hundred or a few hundred, and now they know they're getting quality people. So this company is just really selling and selling and selling, but they're solving a really, really big problem from small businesses to medium businesses to large businesses to big corporates. Everyone needs salespeople.
Right. So you're saying, in my language of when I went to varsity, you're saying the ideal customer profile, it's know who your customer is, know the market, know who's the person that you're going to be selling to. So obviously you need to know who your potential client is. What would be your second one then?
Well, I think you need to know. So ideal customer profile is like, as an example, it's a customer that's got between 1,000 people and 50,000 people. It's someone that works in the HR department, or someone, in our case, in the higher sales, it's someone that works in the sales manager or the sales department. So that's the sort of ideal customer profile. The next one is knowing the buyer persona. So who in that client is actually buying from you? Because it doesn't help me going to the person who makes coffee to sell them Hire Sales. It doesn't make any sense. I want to go to the HR manager. I want to go to the sales manager. I want to go to the chief executive officer. I want to go to the chief financial officer. And that's called the buyer persona.
Okay,
so you need to know who that buyer
is. And I want to stop you there because I want to, first of all, I want to find out how do you find out who that is. But we at the station have also, we've got an ideal customer, and the ideal customer is listening to you, and we've got to sell them some advertising. So I'll join you just after the ad break.
High FM, your station of choice since 2008.
Welcome back. You're listening to the ORT Business Show. I'm David Zeidel, and I'm not listening. Well, I am listening. I'm speaking to, but listening to Clive Butkow. And Clive is talking about, when we went to the break, he's talking about high performance sales. And the first thing he said is, you need to understand who your ideal, or you need to understand the ideal customer profile. In other words, know what your ideal customer looks like. Know the market and the person, but more than that, you need to be able to, within the company that you're selling to, know who the person is that is the buyer. And my question to Clive, before we go on to the other ones within the high performance sales, is how do you know if you found that person, and how do you find that particular person when you're dealing with a company? How do you know that the person you're talking to isn't the wrong person?
Yeah, Dave, it's quite unbelievable these days. There's this incredible social media platform called LinkedIn. It's unbelievable. You go into LinkedIn and you say, this is what I'm looking for. I'm looking for CEOs. I'm looking for CFOs. I'm looking to go into Discam, one of your advertisers there, I heard, and I want to speak to the CEO. And I'll tell you, you will get through to the CEO on it was something they call Sales Navigator. So it's an extra add-on you pay on LinkedIn. But through Sales Navigator, I can go and get hold of David Zeidel. I can get hold of whoever I want, and I can send them an inbound message, or I can leave them a voicemail. And, you get 20, maybe 10, 20, 30% response. You're not going to get 100% response. So my ideal customer profile is a retailer. The buyer persona is the CEO or the CFO. And you go into Sales Navigator, and it will tell you exactly who the person is. It'll enable you to reach out to them, and you hope that they're going to get back to you. And often, I'll tell you, I find when I reach out to people cold like that, I'm probably getting at least 50% response rates. And then I say, I'd like my company to meet with you. And they say, with absolute greatest of pleasure, we'll take the time out and actually meet with you. So, that's the one way. The other way, using artificial intelligence tools today, you cannot not know artificial intelligence in sales and marketing. You can go, and I'm not advertising for Apollo here, but there's an AI product called Apollo. It's got 300 million people on this thing. Dave, if you go there, you'll probably see yourself, your title, your cell phone number, your email address, and everything. So I went and I wanted to find out, I won't give you the details of the company. I wanted to find out the CEO of this company. I went into Apollo. I said, this is the company I'm looking for. I want to speak to the CEO. It came back and gave me the person's name, email address, cell phone number, everything. So this is using artificial intelligence. They have what we call scraping. They've got to scrape all this information from LinkedIn and all the different places on the internet, and they've got exactly that information that you need. So there is no reason today, that you cannot get hold of anyone in the marketplace. And not only that, this is $20 a month. It costs you nothing. And this is all that information that these, and Apollo is just one of Zoom Info, Apollo. There's 10 to 20 of these companies out there that you can use. So there's no excuses today for a marketing or sales team that can't go and find outbound marketing and say, I want to speak to that person. And Dave, you asked a good question. How do you know they're the right people? Well, if you speak to them and you speak to the CEO, he says, I like what you're doing, but speak to the head of sales, or speak to my CFO, or speak to my head of HR, or speak to the head of recruiting, or speak to the head of mental wellness. I've got one of my companies I've invested in is called Oli Health, which is a mental wealth artificial intelligence coach. And we go to the top of we go to the CEO and said, no, speak to the person that's head of mental health and wellness. And we're closing deals left, right, and center. But that's how we know who we're speaking to. So then at some stage, we've got 10, 20, 30, 40 clients. We can then use data and analytics. And one of the lessons is to use data and analytics, because you can, and say, who's buying our product? Okay, it's the chief financial officer that's buying our product. Or it's the chief human resource officer. And that's how we know who our buyer persona is. And there may be 2 buyer personas or 3 buyer personas. So it depends on the clients, but use data and analytics to find out who is actually buying your products. And when you go from 20 clients to 100 clients, that's who you actually target, because more than likely you're going to close those clients.
Wow, that's fantastic. And then number 3 on your list?
Well, I think this is a very important one. I know we don't have a lot of time. It's probably maybe 1 or 2 left, but this is the one that you have to know who all the players are in the client. If you go and try and sell something into Standard Bank, there is no one person. I'm just using Standard Bank as an example. There's no one person you can go and speak to that's going to say, yes, I will buy your product. There's the buyer. There's the sponsor. There's the user. There's the saboteur. There's so many different layers of people and committees that it has to go to get to your yes decision. I'll give an example. When I was at Accenture, and I won't mention the client, but this client, we were selling a really big ERP implementation. It was about a 500 million rand project, and they had 43 committees in this client, and every one of those 43 committees could say no to the deal, but they couldn't say yes. Only the 43rd committee could actually say yes. So they could say no, and the deal was off. So we had to go and lobby, and we had to know first and foremost who's the committee number 1, 2, 3, 4, 5, up to 43. We had to then go and lobby all those 43 committees to make sure they at least didn't say no. They said, it's okay, I'll let it go to the next committee. You have to know who is, and this is such an important lesson. You have to know exactly who is in that decision-making process. Who says yes, who says no, because some people can just throw a hand grenade into it and say, I don't want this thing to happen, or I don't like Clive. I don't want to buy from Clive because I don't like Clive. You've got to at least neutralize the people that don't like Clive. So you've got to know who is in that decision-making process. And and people often say to me, well, Clive, how would we know that? So my fourth lesson is get a coach. You need to get a coach in that client environment. So if the company's called A, you need to know that you have a coach in A. And that coach will tell you, for this deal, you need to speak to that person, that person, that person, and that person. That person won't say yes, but if they say no, the deal is off. So that Clive, person's a user. You've got to get them on board.
So when you say a coach in the organization, it's somebody who's dealt with the organization or somebody working in the organization?
No, working in that organization. And it's quite amazing, When I was at Accenture, we got these coaches my next lesson I'm going to talk about is account-based management. So you need to understand which accounts do you actually want to get into. So you take the JSC top 100 clients and you say, okay, for the product that we're selling, mental wealth, we want to get into these top 10 clients. You need, preferably, if you can get a coach in that client, because I tell you, the coach wants to help you. If you make the coach successful, if you work in there and you make the coach successful, they want to help you. And I'll tell you, they came into our account-based management session. The coach from the client was sitting in Accenture's sales sessions. That's how we got them to tell us exactly. They didn't influence in any way, but they told us, for that deal, you need to get to those 5 people. For that deal, those 6 people. But we had made them successful, so they wanted to help us and make us successful.
So you're not getting a coach because you're paying them. You're getting a coach because they see the benefit of your product in their company.
At the end of the day, if you're paying them, that's illegal. So you can't do that. At the end of the day, we are making them successful. And that's all they cared about was their success. So if they knew they appointed Accenture or appointed one of our companies now to make them successful, and they knew they're going to make them successful, they more than wanted to go with us. So it's all about it's WIFM. If you don't know what that stands for, what's in it for me? You must always ask, if you're speaking to Clive or you're speaking to Dave, what's in it for me? Because all clients care about before they buy your product is what's in it for them. You've got to make them successful. If you make them successful, they'll make you successful. Amazing. So you've got to know what are their buyer values? Why are they buying you? Because they want to be successful. They want the best team. That maybe the best price is not what they're looking for. Often it's not the best price that wins. The best price wins in a commodity market, but they're pricing to value. Maybe they're not pricing to price. So you need to spend the time with a coach to say, what are your buyer values? When Clive makes a decision for you, what is he looking for? And you need to know that he wants the best team. He wants something delivered on budget. Dave?
Yeah, so we're going to head off for another break, but when we come back from the break, there's a couple of questions, and one of the questions is, what's the benefit to a business to get investors? So why would the business or the entrepreneur get the investor? And entrepreneurs are different animals to investors. Investors want hard figures. Entrepreneurs, is there a middle ground between, and we're talking about a smaller business, but I'll look at this question and maybe phrase it slightly differently. And it's interesting, your question about what's in it for me, which is WIIFM. And you're hearing about the WW or the WIIFM on High FM. So we'll see you after the break.
High FM, 101.9 megahertz of life.
Welcome back. You're listening to the ORT Business Show. I'm David Zeidel. I'm speaking to Clive Butkow, who's your local Shark Tank or dragon, who's invested in many different businesses and sharing quite a few amazing lessons with us. And one of the questions that came through, Clive, is what should entrepreneurs look for in an investor? So we're turning it around a bit. You've given it from the investor's point of view. What's the benefit to an entrepreneur from getting an investor involved?
I think, that's a great question. I mean, number one, you get an investor involved because you need capital. So you're either starting out your business and you need to build maybe it's a health tech product and it costs you a lot of money. You're investing in the next CT scan and you have to raise a lot of money from investors because you just cannot build the CT scan or whatever it is, whatever product you're building without capital. The other reason you raise capital is for scale. So you're now growing at 10, 20% month on month. You're hitting your gas or you're putting your foot on the gas and you can just see growth and you're closing more clients. But you need capital and capital efficiency. You need to have a good capital that you can actually go and close more clients so that you can go from 1 million to 2 million to 4 million. There's something called that we look for when we make an investment. We call it triple, double. And what that means, I want to see a business that can go from $1 million and then triple to $3 million in 1 year, then triple to $9 million in the next year, and then double to $18 million, double to $36 million, and double to $72 million. Because if I can get the triple, double, which is this metric or rubric I'm using is used right around the world. And if you can get that, you can build a unicorn, which is $1 billion business. Those are the ones in 100 you have to find. You can find the triple, double. But that's the type of businesses that I look for. So that's why an entrepreneur needs an investor, because they can help them. And you want to find, for an entrepreneur, you need to do your due diligence on that investor as well. Money might all look green and all look the same, but your investor is fundamentally different. Some are going to really get involved like I do and help you build this business. I'm going to help you with sales, marketing, go-to-market, product, finance, engineering, human capital, everything. I'm going to help you hire people. I'm going to do everything and help you with your business. I'm not going to run your business, but I'm going to help you advise you on things that maybe you should look out for in your business. So you need to get what you call a smart investor and smart capital. So that's very important for the entrepreneur to look when they do their due diligence. The investor's going to do a detailed due diligence on you as a founder. So why don't you do a due diligence on the investor? Speak to the entrepreneurs. Maybe they're toxic investors. They're bad for you. They're not going to support you when you want to raise capital or you want to sell your business. They're not going to support you. And they're on your board and you need their support because they've got veto rights to these type of decisions. So please don't make those mistakes. I see them every single day when entrepreneurs or founders are desperate to raise capital. They give them any terms. And that probably was the 6th T I left out, was you need to have good terms. Don't take any term, because if your founder, if your investor can stop you from selling your business, you've just sold yourself down the river, because they will stop you and they can stop you, and you get this unbelievable offer. So for you, it's a great offer. You can make $50 million, but your investor might only make $10 million, and they will say, no, I didn't invest in this business for $10 million. I invested in it for $100 million, and they will say no to your deal. And they can do that through what I call veto rights. You have got to make sure, and reach out to me on Clive Butkow on my LinkedIn if you really want advice. So I'm happy to advise any entrepreneurs and mentor them, because I see them all falling into the same trap. And it gets to me when I see entrepreneurs making this mistake.
So Clive, I must share with you, a lot of people, they listen to the podcast, and this podcast will be available on High FM later. But a lot of podcasts, when we listen to them, and I do this, I listen to it and I put up the speed. It goes from kind of sometimes I listen to 1.5 times or 1.7 times. And I've got to share this with you. I thought it was quite funny. I just got a message in to saying, I want to listen to Clive's podcast, but I want to listen to it at 0.75. I think Clive is talking like he invests. This is a 1 hour show and he's getting 2 hours worth of value out of it. So thank you for that.
You know what, Dave? You can't hide passion away. You can hear I'm passionate about this stuff, and that's why I go at the speed of the bullet train. But you're absolutely right. I think you've got to listen to this about 0.1, and you might actually understand and hear what I'm saying.
Yeah. So I think that's amazing, and there's quite a few numbers that you've come and you've spoken about, and you spoke about the what was it with the know your numbers in the business. And you talking about numbers, and you spoke about like a home run where you got to go 2 home runs when you're investing. You're looking for 2 home runs or 6 that get to the base, and you will have those strikeouts where you're out. I've just got a message from the engineer who said that I need to start wrapping up. So I'm going to talk a little bit slower than Clive spoke to give you maybe some of the things. So Clive spoke about you need growth capital to grow your business, and the investor will look at the 5 T's. And the 5 T's were team, that you need a good team, you need technology, you need a targeted addressable market, you need traction, and you need the trenches, which is a moat that it's harder for others to get in. And then he gave us a bonus one, and that's the terms. Have the right terms when you're doing the business. And then from the high performance point of view, he was saying that you need to know who your ideal customer is. You need to know within your customer who that buyer is. You need to go with understand who the players are and get those players on your side, and you can get that by an internal coach. And you need to manage it with accounts. Clive, I think we need to get you back at some stage to unpack the rest, but I think some of these lessons are unbelievable. And you ended off with saying, use the technology that's out there, the Apollos and the Sales Navigator from LinkedIn. It's been amazing. We've got it at the speed of light. And so I just want to thank you on behalf not of the WIIFM, but from High FM. Thank you for everything that the value you've added, and I know the value that you add also to ORTjet, and it's been unbelievable interviewing you, and thank you, Clive.
No, thanks very much, Dave, and good evening to your listeners. Cheers.
And this is David Zeidel, and this has been the ORTjet Business Show. Good evening.